Hi, this is Steve from Freshagenda. Last month we were in the States and we did an interview discussion that was with Matt Gould.
Okay.
Today I'm with Anup Singh, who... Anup, how would you describe yourself? I mean, I could try, but...
Well, my description is that I'm married into a dairy family, and I entered the dairy business to claim my share of cows when I had no idea what cows were.
Right.
And I'm very happy that I didn't claim the share of cows, although the cows did claim a share of me.
Always.
And I moved from the oil business. That's right. And I moved from hydrocarbons and palm oil into being an analyst and a trader in the dairy markets.
Okay. So your base is now...
Yeah, that's a confusing topic.
Yeah.
I'm based where the cows are, so my home is Vermont, and I work in New Zealand.
Excellent. That's got to confuse a lot of people.
That's right.
Look, we're going to cover a few things in this discussion. We're going to talk about skim milk powder.
Yeah.
We're going to talk about whole milk powder, what's going on in New Zealand.
Yeah.
Pretty interesting situation. American cheese.
Definitely.
Specifically American cheese.
Especially American cheese, yeah.
And
Cheddar.
yeah, and let's talk about some in-market regions and what we're seeing in terms of where prices are, where landed costs are at.
Yep.
We did some earlier SMP analysis on the potential impact of the release of intervention stocks and the release into the supply chain, so into commercial hands. And we looked at what magnitude that might be, and if you look over a 12-month period between July, when things started coming out of intervention, and June this year, look at the amount of additional product availability for the market, taking account of a few things.
Yep.
So what we're looking at in this chart is some earlier work we did, and we'll update this. But essentially in this chart, we've started with the amount of stocks that have come out and moved into commercial hands. Then we adjust for, essentially what we're trying to calculate here is what's the change in availability, what's the net addition to available skim milk powder in the market.
Which is the last bar on the right.
That's the last bar, that's right. So we've got to take account of expected fresh output, the change in fresh output over the year. The same in the US, same in New Zealand. And then you come along and there's a bit more Indian export product coming out, and there's probably not as much as we might have thought earlier in the season. Then looking at changes in consumption now, the EU might consume quite a bit more in the feed sector. The US is actually not consuming more skim, in fact they're going the other way, aren't they?
Correct.
They're using less.
Domestic disappearance in the US is, if we compare to averages, it's alarmingly low.
Yeah.
And that sets a sort of a tone of alert in my head. Mm-hmm. Is it really that low, or is it some data reporting issues or stuff like that? But it's on a high alert.
Yeah.
If it is low, and if it's low and the market's not relatively well covered, then it sets up for a price move. Yeah. Surprise, could be either direction.
Yeah.
But largely to the upside.
Yeah.
And I wonder if part of the thinking also that's going through my head is, so the cash basis in the case of non-fat, most of last year, at least through November, December last year, has been pretty tight. Mm-hmm. Basis has traded, some parts discounted, but mostly at a premium or if not flat basis to futures, and that is pretty prescriptive.
Okay.
So clearly the domestic market is tensioned. Yeah. So no, that's a big topic. Now, I think the counter argument could also be, you see the class 4, class 3 spread. Now, prices of butter have not changed materially. 230 to 225, big deal. I think it's non-fat that's keeping, class 4 where it is. So now when more condensed skim makes it to the dryer, does that sort of ease the tension of it? Maybe. Yeah. Maybe it does. I think the bigger eyes in the short term are probably on the tender results from Mexico, which is back to this chart, which is a fascinating chart to me. Is you see the way we look at it from a price standpoint is between July and Jan, the entire skim complex with some variations of products has rallied anywhere from, let's say, 25% to 34, 35%, including animal grade skim. So, economically speaking, if there is so much product, well, why is the animal grade rallying? And if there is so much low quality product in the market, why hasn't that converged with the animal grade? So there's some gaps in the pricing. Yep. And with the bar on the right-hand side, available tonnage is above 250,000 tons.
It's additional supply.
Additional supply to the market. Why is the price where it is? So there are all these very interesting questions, and to me, what then that makes me curious about is it because, well, first, the commercial ownership is financing, $150 million worth of inventory. So either there are guarantees from buyers that they will buy, so some back-to-back commercial arrangements, or there isn't a line of sight into replacement product, so you want to hold on to that to supply dairy solids into the market. And the third is just uncertainty. And uncertainty, what I mean by uncertainty is in a positive way, is you see, so going into mid last year, we had a very strong US dollar. And US dollar alone is not very interesting. What's interesting is strong US dollar with high crude oil prices. So countries that buy dairy solids, they're also consumers of crude oil to run their economy. And so liquidity becomes tight. You can't get access to US dollars to go buy other commodities. So the things that you want to buy, you're not able to buy, but the things you need, then you go buy that. And I suspect some of that, although I think I am in a minority when it comes to that opinion, is that I think that matters. I think most people argue with me that it doesn't matter, but I think in the case of skim, I think it does matter.
Okay. So we've got about 250,000 tonnes additional supply. We've seen a surge in demand on the demand side, right? And trade data will show that, and we're looking at some of those charts now. That have shown that surge at low prices. So low prices are helping fix low prices, but will that be enough to counter it?
Correct, absolutely.
And is the market belief that demand will stay there and soak up that additional product? That's quite a lot of product, because in the growth that we've typically seen, I think we've measured that it's 2 years export growth globally in that number. In that number. So that's, with the surge that's occurred, that's going to be above trend.
Sure.
But it is going to be an interesting as that plays.
Absolutely. And I think this is going to jump the guns a bit. The corollary to this, what is this displacing?
And you've mentioned this when we talked about this earlier. It's a really interesting point. So where does this fit into the...
Because you see, if you think about it, year over year, the demand for milk solids, and let's just say powders, and maybe some blasphemy here of putting whole milk powder, skim milk, and fat filled all in the same bucket.
I think we're in a non-sensitive audience.
So if you think about it, you add all that things up, year over year growth of exports, and we think in terms of exports as a proxy for end user consumption and demand. That number is growing 2.5% year over year, all powders combined. So I think that's on trend. And so if this is 250,000 tons excess supply, what is it displacing? I think it's displacing a little bit of whole milk powder. And that's the displacement is less to do with elastic demand, because I think elastic demand displacement between fat filled and whole milk has already occurred at these price levels. I think what's getting displaced is inelastic whole milk powder demand from the past that has now been reformulated to stuff that can consume fat-filled powder.
Okay.
And I think what we are seeing, 250,000 tons still is a massively big number. I think now, fast forward 2 years from now, we may look at this number and say,
what were we worried about?
Correct, exactly. But at the moment is, I think unless we get and there's some work we need to do, I think both of us need to do, is sort of put some estimates and ascertain what that inelastic demand might have shifted. But my thinking is that in the near term, that's a big one. The other part that I'm not still clear about is, you see, so in the fat-filled milk powder plant, what's the stuff that goes into the plant? Condensed skim is preferred. If you don't get condensed skim, you put some skim milk powder and reconstitute with some condensed skim, and there's various formulations of that. Now, if you look at the European exports of condensed skim, I don't know how much of that is sweetened versus unsweetened, but you need unsweetened to put into fat-filled plants. The condensed skim exports from Europe have also gone up. So I wonder if that condensed skim leaving the skim milk stream that would have otherwise gone into the dryer is also tensioning this this thing up as well.
Yep. Across to New Zealand, and we've heard lots about the soil moisture deficit, and that's getting worse, and no rain on the horizon, no real rain on the horizon.
Right.
And the soil moisture map, which strikes a bearing resemblance to Donald Trump in terms of the orange appeal and that sort of facial tone that's been achieved. But on this chart, we've just put together, and I've wrestled with how to present these numbers to try and make sense of what's actually occurring, and maybe there's one way of doing it. So I've put on a cumulative 10-week rolling PGI average. Right? So if you roll for 10 weeks, it shows you where you are, because if you just take the cumulative the whole year, you miss the effect of that late kick that we saw last year, which was very, very important in building late season growth. So the red line shows where we are in the current season. That's up to last week. Yeah. So we've got a big steep dive, but look where we've been. We've actually had pretty good growth, and probably a fair bit of cut silage. Yep. And we're speculating about what's going on farms. Sure. But that's probably buffering this right now. Yep. So we've got a little bit to run before this becomes a crisis. Yep. But if we don't see a change in the rainfall, then that might become more realistic. So we're trying to look here at, so where does it go from here, and what of the recent years, and those lines there are recent years that have had similarly bad weather and poor growth through this February dip.
What's intriguing about these lines is the steepness of the slope, the dark blue one at the bottom and the red. Yeah. Right. These 2 years, the steepness of the slope is more pronounced. Yes. Than some of the years in the past. Yep. And it probably has to do then shapes the size of recovery or the shape of recovery as well.
Absolutely, I think that's right. So the extent to which you will rebuild is certainly limited by where we are and how quickly we've got here.
Absolutely. Now, do you think there's a difference in? I didn't appreciate this until I started living in New Zealand last year. Is how different the North and the South Island is. South Island is largely more irrigated. North Island is more weather driven. Yep. So production in the North Island takes, I think, a bigger hit on weather uncertainty, and South Island. Like I said, I don't have a lot of quantitative rigor to back this up yet. It's just more qualitative observation.
I think that's right. As we've observed through the seasons, and we're now looking at the difference between the North and South Island PGIs in the same chart, and they're starkly different here. Yeah. But what you see I think there's a much weaker correlation between these moving PGIs in the South Island with production because of irrigation. Right. And there's a bigger feed investment, infrastructure investment that occurs, and so that's probably buffers that. Yeah. I think the North Island is directly exposed. The futures. So when we think in terms of drought premium, we would look at March-April futures. Yeah. And what the March-April futures. We're just looking at those now. Yeah. Yeah.
So the point is, you would expect that to price it starting December, Jan timeframe. So if the market's concerned with drought and lesser, tighter availability of product, we should see that arguably in the March-April futures.
So what I've looked at from those curves is saying which of the seasons might we see occur in the way the season runs down. Yeah. So which history can we learn from in how the seasons run down, and then apply that to where we are in this current season.
And those relative movements are very valid. Yeah. The absolute prices are interesting, but I think the relative movements would hold true.
Yeah. And from what we see now, we're probably looking at something between a 2 and a 2.5% full season. Yeah. Which means we're going to lose quite a bit off the back end of the season.
Correct.
In terms of
the
curve. So if we apply that, this is the premium you've talked about. So what we've run here is we've just run that in our DTS. Yeah. Just flexing that New Zealand season finish and showing the impact that has on the fundamental value, and that's where the premium's been priced in here.
You know what's fascinating about these numbers is that so we drew futures. Different markets behave differently in the sense as markets largely reflect who's in it. Yep. The people in the market who make up the market, and if everybody in the market looks at technicals or charts and draws lines on it, it becomes a self-fulfilling prophecy because certain levels do certain things to buyers and sellers.
Yeah.
So beginning of the season, I think in June, July timeframe, we had drawn lines on the charts, and 3,400, 3,375 is where we put the top at, and we put 2,400 at the bottom. So we never tested 2,400. Market came down at 26, and that was the base, which is kind of nice.
Yeah.
This is uncannily close to 3,375, 3,400.
Yeah. So if it gets worse, we'll be there. And if demand kicks a bit from here, so and it's tightening, supply is tightening.
I would think that from a commercial business standpoint, what I'm inclined to think is inelastic structural demand, meaning demand that would usually plan a buying program, should be committed and bought by now, maybe unpriced, but they should have they should have supply security by now.
Yeah.
So what's left in the market is on the fringe, unplanned demand or elastic demand. And I think elastic demand at these prices should step away.
Yeah.
So I think what we're left with, even though we feel that, supply demand, carry out stock in for the end of the season is tightening, tighter than previous years.
Yep.
But I'm I'm trying to keep my the depth to which I'm married to 3,400, just because it's an interesting number. It combines what this model, the value model, is showing and what we were looking at. If we put that park aside for a second, I feel that with the elastic demand stepping away at certain price points and structural demand should have price or access to security, I think if the price values too much beyond 3,400, a lot of buyers will become sellers.
Yeah. And
resellers should sell aggressively at those prices as well. So I think there'll be some good sell side interest at those prices.
Yep. And
so I think the numbers seem very reasonable to me.
Yeah. So let's go on to the US cheese market, cheddar or cheddar blocks in particular.
So this market is interesting because you and I didn't quite agree on the outlook
in December.
Yeah. And I would say that you were right, I'm wrong. And the phenomenal part is because I think by and large we had similar ideas, but your point was that no, I think cheese rallies in the first half, and my view was that no, I think cheese competes in the first half, doesn't rally in the first half. I find it difficult to see it's rallying. But I think what gives me confidence, not in the price but in the process that both you and I follow, although is different, but it's very similar from a discipline and structure is concerned.
Yep.
And it is that process then that allows me to reevaluate all assumptions at all points in time. You see, market's not mispriced. It's our opinions and our process that's either early or too late.
Yep.
And so the mispricing is in the opinion of the market.
Because the market's always correct. Price is always correct.
Price is the king. Yep. Somebody is putting money at risk by buying a product. Yep. So clearly, the futures, again, tell you a lot and how the futures are traded. So May futures. So when we're in the month of December, I look at May futures. When I get close to May futures, I will switch to start looking at August futures. These are also interesting switch months for trimesters. So milk produces Jan through April. April is when we go into summer mode. Class 1 demand falls off. Most of it is in commodity demand. And then there are switches in the system. So May futures through the month of November, December were flat. Jan was extremely weak.
Yep.
Now, we look at the news flow that was coming into the market between October, November, December, is a lot of new capacity coming online, expect more cheese, expect more cheese, expect more cheese. My thinking at that time was, if the flow of cheese maintains its pace into the marketplace, US will have to look at the international market to clear excess inventory.
Yep.
So that was premise one.
Yep.
Premise two was a nuance, which is more other cheese means less cheddar. Less cheddar means a higher price signal in the cash market. And then within less cheddar, if less cheddar is less 40 pounds block, which is the specification of the CME market, that's a high price signal. It still doesn't mean there is less cheese. There still could be more cheese, we just don't know about that yet. So I think that's premise one. Now, having said that, the second element is the cheese that was in cold storage, I suppose it is still in cold storage. It's not in the USDA cold storage. It's in somebody else's cold storage, which is aging. So the more cheese that goes into that pipe, if you will, displaces some future demand at some point.
Yeah.
And it gets exasperated during the flush. And the flush is really not as much structural flush as class 1 drinking fluid demand goes down. So that milk then shows up in the cheese plants in May, June, July, August timeframe. So I think it takes some wind off the sail at that point. So if cheese would have traded low first trimester this year, I would have thought it would be a good thing for the second half of the year.
Yep.
Because then you clear the problem is sold and done with,
Yep.
and then be back to where it should be. I think higher prices lead to even higher prices, then that lead to very steep falls.
Yeah.
And then low prices lead to lower prices. I think we're sort of in that market.
Yeah.
Right? So the key question then is, well, why is the cheese rallying? There are probably three possibilities.
Yep.
And one, we talked about specification and less cheddar available.
Sure.
I think second is not as much tonnage being produced as anticipated. So the May futures actually, for the month of end of December, early Jan, actually came down significantly. And since the end of Jan into early Feb, have traded up significantly.
Starting to move,
Yeah, starting to move up.
Yeah.
So there's some anticipated volume that probably did not show up. So I think I don't know. That's where I stand at the moment. Is I look at prices and especially cash basis, which informs everything I do and think.
Yeah.
And basis was weak. Basis is strengthened. Basis is strengthened. I look at these principles, and then what hasn't changed is milk production.
No.
Milk production is flat or higher. Let's just say neutral to 1% up.
Yep.
Assuming capacity is still where it is. 1.3 billion last known reading on the USDA cold storage, 1% growth, everything else remaining the same. Ending number is not 1.3, it's probably 1.4, 1.45 billion. Assume some demand growth, domestic disappearance growth. That number is still 1.3 billion or thereabouts.
Yeah.
Thereabouts. So if we just look at that, and we haven't yet added new production capacity into the mix, 175 is a heavier number. What we've definitely seen is 120 seems to be where there's value buying, and there's value, and I have no reason to disagree with that. So the market's somewhere between the two. It's a big range. I would have thought that 135, 130 would be first half. Have to be proven wrong. I think what we're seeing is setting up for a 145, 150-ish. 165 is the sticky point for retail demand. So I think there's some pivoting around that.
Okay. But the thing we also talked about was this divergence between class 3, class 4.
Yeah.
That's no doubt pulling more milk into, or pulling more milk away from cheese.
Phenomenal point. Yeah. I think there are two interesting stories on that one. Stories meaning two interesting things happening in the market. One thing I had underestimated is the impact of the California marketing order, the California entering the marketing order, and the impact that is likely to have. So California, the price that used to inform the milk from a cheese standpoint used to be CME block. That number is now NAS average. Now, if you look at that and you look at if depooled class 4 plants, that's a huge price difference for the shipper. And I think that tenses up California production, because my understanding is that a certain set of class 4 plants are depooled at the moment. So the shipper there is getting a nice premium, and the shipper to the cheese plant is not getting a premium. So he would minimize to the contractual minimum that he would ship to the cheese plant, which would then tension up commodity cheese coming to the market.
And we're going to see a bit of that shortly.
Correct. So I think there is definitely that. The other aspect is, and something that we've chatted about in Freshagenda team, that we should do some analysis and present it in the coming few weeks or months, is also what is the barrel to whey spread. So anybody who's making barrel is also making whey. And if they're losing money on barrel, but they're making money on the whey and it's break even, well, probably that will continue.
Yep.
until both the streams lose money. We know
Yep.
barrel's losing money,
Yeah.
but as long as it's being compensated by whey,
Yeah.
I think that works until that doesn't work.
And as long as they're getting the most they can out of WPC,
Correct.
which is firmed quite
Yes,
well.
absolutely,
Yeah.
absolutely. Now, having said that, I think the part that I found myself in a lot of discussions recently, and leading up to the end of the year as well, is this class 3, class 4 spread.
Mm-hmm.
I think the memory that the market has is that whenever class 3, class 4 spread, class 4 has gone at a premium, 3 has followed, very violently followed.
Mm-hmm.
And I am fairly, despite my grey hair and my age, I'm fairly young to the dairy markets. Now, the last time this happened, US had more stainless steel than they had milk.
Mm.
I think we are not in that environment anymore. We have milk surplus compared to processing capacity. So I think that violent change in structure,
Mm-hmm.
I have to really put a lot of thinking into why would that occur.
Yeah. Okay.
I haven't concluded as to that should necessitate
Mm.
a class 3 violently turning up.
Mm-hmm.
I think the way the configuration of assets is in the country, you see, if class 4 is at a premium to class 3 by $1.50, one school of thought would say, well, milk should move from class 3 to class 4 plant. But the class 3 to the plant needs to be within 200-300 miles
Mm.
distance.
Yeah.
Else, by the time you do the freight and back,
Yeah. It's not
a feasible,
It's not viable, no.
not viable.
Yep.
Now that doesn't mean that could, but then that also could lead to skim condensed.
Mhm.
So cream has been taken out at source.
Mhm.
Cream is going to the butter plant or other purposes, and the condensed skim, could travel
Yep.
from the Midwest to Pennsylvania drying facility,
Mhm.
and we still may get non-fat out of it.
Mhm.
I think there is some of those changes unlikely to happen.
Yeah.
But in this milk surplus market, I mean, milk surplus hasn't changed.
No.
And you would know this better than I would, but I don't think milk surplus has changed.
No.
And if milk surplus hasn't changed, the violence with which class 3 would rip upwards, I'm not yet convinced about that.
Okay. Yep. So the last thing we look at is affordability in markets.
Yeah.
And we know the story well that the US dollar is strong. That's pushing some of the as prices are firming across the complex.
Yeah.
We're seeing challenging the affordability in some of the developing world markets, which are inherently price sensitive.
Definitely.
And here we see just a selection as we go through a few examples of some work we've done to restate both the spot prices and the average shipped price into destinations in some of the Southeast Asian markets, in particular in China, showing how that lands in their currency and how that's shifted over time. So we've seen quite a higher cost because of the upward movement of the US dollar against some of these currencies. Some of those currencies have weakened by themselves across the board.
Yeah.
But this is a challenge. Now, there's more work to do here. Obviously, there's some other dimensions.
Yeah.
I think this is a new piece of our analysis that we're going to extend further and be in our coming attractions.
Yeah. But I would say that this is if we borrow practices, I would say not borrow, we should adapt practices from other commodity markets.
Mm-hmm.
In other commodity markets, which I come from,
Yeah.
this is a very standard practice way of looking at markets.
Mm-hmm.
I think what informs, as we were saying, markets are a function of who's in it.
Yeah.
So the merchant who is putting on risk by buying the product and taking ownership of the product and taking them from international waters ownership into domestic ownership,
Mm-hmm.
this plays a huge role in that movement. And there are two interesting dimensions to that. One dimension that we will explore, as you said, is looking at replacements.
Yeah.
The second dimension is also the dollar part of it, which is, if risk perception is high, I buy close to home.
Mm-hmm.
And what I mean by close to home is, one, I buy nearby origin, and second is I don't buy far forward as much.
Yeah.
I buy as much as I need, and I may go back to the market with greater frequency, but the size of risk I put on is it's much smaller.
Mm-hmm.
If the risk perception is lower, then I go afar And what I mean by afar is, in the calendar.
Yep.
So I'm happy to book longer.
Yep.
And have a line of sight.
Mm-hmm.
And I think this is a phenomenal starting point to look at the destination markets with that lens.
Yes.
I think we should definitely spend more time in the coming weeks and months to firm this.
And try to understand stock turn that's occurring in those markets and how quickly that is rolling.
Because as a merchant, let's say I'm a merchant sitting in Indonesia and I have a cost of ownership, and let's say, usually we'd like to say what the local basis is. So what that means is what is replacement compared to the stock that's in the country, and if replacement is lower, I buy the replacement, sell the stock in the country.
Yep.
If the replacement is higher, I mark up my stock, and I have a parity market. And that influences then where I am in the season and the number of turns.
Yep.
Which then impacts the bid on the origin. And I think this is fascinating. I'm very excited to see what the next few iterations of this analysis looks like.
Yeah. Well, that's good. Look, we've covered some interesting topics.
Yeah.
It's been an honour having you.
No, thank you for having me
in our studio, which is just our meeting room.
Right.
To kick through these topics, we'll do this again, I'm sure.
Yeah.
Anup, thank you very much for coming in and being part of this. And thanks, folks, and we'll be back soon.
Thank you very much for having me. Pleasure.
Pleasure.